I still believe when gold is outperforming lumber, that tends to be a defensive signal because that belief is proven in history outside of the small sample of the last year and a half where treasuries have failed independent of whatever signal you followed as a risk-off option because you've had no real risk-off because credit spreads have stayed tight. I do think gold probably still has a lot more room to go. I mean, I still maintain that gold is the ultimate diversifier because historically it doesn't correlate to very much, kind of marches to its own beat.
In the early 20th century, as developed nations moved away from the classical gold standard toward a system of fiat currencies and central banking, gold took on an additional role. It became a hedge against inflation. Many political analysts have cautioned that geopolitical uncertainty will further accelerate the deglobalization trend, leading to a multipolar world. This shift will enhance gold's appeal as a neutral financial asset. Michael Gayed, publisher of the Lead Lag Report, joins us to discuss the outlook for financial markets in 2025. We delve into key topics such as market manipulation, deregulation, the role of gold, small-cap stocks, and the possibility of a credit event. We analyze the trends, risks, and opportunities that could define the year ahead. Stocks surged in 2024, marking a second consecutive year of gains over 20%. As investors welcomed cooling inflation, declining interest rates, and the potential for lower corporate taxes under a second Trump administration. Similar to previous years of market euphoria, tech stocks once again captivated investors, but this time, the promise of artificial intelligence, AI, fueled the optimism. Michael Gayed, however, emphasizes his preference for market prices over economic data from policymakers, often influenced by political agendas. He argues that despite criticism, the lumber-to-gold ratio has proven to be a reliable predictor of market trends over time. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
And we are now at the stage of the cycle where the bulls who have, in quotes, been right, and really they've only been right based on the indexes, not based on small caps and most things, which again are still, after inflation, doing terrible relative to 2021 respective highs. We're getting to the point where there's a hell of a lot of, I would argue, beating of the chest, arrogance, look how great we've done type of sentiment out there. And I would remind people that hubris, and I've been through this in my own career, occurs before you start to fall. Right? It's when you feel like you're walking on water that you start to sink. For whatever it's worth, I just think anecdotally we're seeing a lot of that. Now, again, that's not a timing, argument. It's just saying that we're clearly at a level where people are all on the same side of the boat. And look, the crowd is right on average, just not at the extreme. So the only question that matters is, are we at an extreme? Markets being at new highs is not a definition of an extreme. People being all in on markets is by definition an extreme. And there's all kinds of interesting stats that do suggest that when you look at household asset exposure to equities, you look at optimism, sentiment, we're kind of at that point where mean reversion might kick in. It's like, how many revisions are there out there? Does anybody really have a clue what the real state of the economy is? Because I would tell you what, small caps, if that's a clearer sense of the real state of the economy, have been saying, it's okay. It's not phenomenal. Right? I mean, small caps are much more tied to the domestic U.S. consumer than large caps, which are multinational. So if you want to make a play on the U.S., you're making a play on small caps. It hasn't really worked that well. I'd rather use market prices than economic data from policymakers that are trying to stay in power. I use a lot of market, intermarket signals, right? In the way I tend to kind of form a thesis. People will say, your lumber to gold signal has been wrong. There's no predictive power. It's like, that's stupid because you can look at the white paper, which is pure fact on that. And actually, as a matter of fact, lumber to gold has actually worked out very well. What has not worked is the expression of treasuries against that signal. That's a whole different discussion. So no, I mean, to me, I still believe that there's cause and effect. I still believe that when utilities outperform the market, that tends to be a defensive signal. I still believe when gold is outperforming lumber, that tends to be a defensive signal because that belief is proven in history outside of the small sample of the last year and a half where treasuries have failed independent of whatever signal you followed as a risk-off option because you've had no real risk-off because credit spreads have stayed tight.
Gold has long been regarded as the ultimate safe haven, offering protection against uncertainty and economic instability. In contrast, Bitcoin, often referred to as digital gold, has risen as a disruptive force, presenting significant growth potential. With Trump poised to return to the White House in January, His influence has helped propel Bitcoin to a series of record highs, showing little sign of slowing down. As a Trump-driven rally adds new momentum to financial markets, investors are left questioning, could Bitcoin be a more attractive asset than the traditionally dependable gold? Michael Gayed believes that gold has considerable growth potential and remains the ultimate diversifier. Unlike markets like crypto and Bitcoin, gold typically doesn't experience much leverage, which makes it particularly appealing as a counterparty asset. He emphasizes that gold has historically moved independently of other markets, making it a unique and reliable store of value. Now let's redirect our attention to a video.
I do think gold probably still has a lot more room to go. I mean, I still maintain that gold is the ultimate diversifier because historically it doesn't correlate to very much, kind of marches to its own beat. Not a lot of leverage in the gold market because people are leveraging crypto and Bitcoin instead. So I think gold still has that counterparty attractive aspect to it. I do worry about the dollar continuing the way it's been continuing. Now maybe it's a top or close to a top. But if the dollar were to keep on rising, that is going to be a self-fulfilling risk-off play because it creates this almost short squeeze dynamic where it creates some funding stress in international borrowers. That financial stress then results in the dollar even going up further. And then it's like, a blow off in the dollar, which would make it a risk-off play, but would probably be very painful for everything else around it. And I still think utilities look interesting alongside healthcare. Healthcare is going to be unique in the deregulation trend, I think. See what happens as far as deregulation and FDA approvals. But yeah, I think there's a lot of interesting dynamics that are coming. Either way, look, the last 2 years have been shockingly good for U.S. large caps. We know a large part of that's the AI, NVIDIA, Meta type of plays. We're probably due for some broadening out, but broadening out can simply mean that the things which have not participated go down less, while the things which have driven the rally go down. First of all, let's be very clear. Everything is manipulated. what are we talking about here? Everything is manipulated.
There's my YouTube title, by the way.
I know, really, everything's, of course it's manipulated. The Treasury is manipulating liquidity. The Fed is manipulating liquidity. They're manipulating algorithms by what they put in a statement that they're probably going through AI to filter as far to see what the reaction by the other algorithms are going. Everything's being manipulated. Like, what, you think fair value for the S&P 500 is where it is now? That's not manipulation. So when I say there's not enough leverage or it's not no real leverage in gold, what I'm talking about is there's no over optimism. There's no overconfidence in gold. I don't see people excited about gold. I see a lot of people talk about Bitcoin 100K. I see random posts about live streams. Bitcoin reclaims 100K. And it's like, oh my God, what is going on? That people are like, this is like a casino that we're just creating content around. Like nobody's talking like that for gold. When you start seeing, that type of stuff on X, and silliness around gold like you're seeing in the crypto space, then that means there's leverage. And that's when it's going to turn negatively.
History shows that gold tends to perform well when interest rates fall, as central banks usually cut rates to stimulate growth during periods of economic stagnation. During such times, stock markets often face challenges, making gold an effective hedge. Additionally, central banks increasing gold purchases, particularly from emerging markets like China and India, are driving the price higher as these countries seek to protect themselves against global economic fragmentation. In your opinion, why are emerging markets like China and India increasing their gold reserves? Drop your comments below and let us know what you think. If you found this video helpful, please like it and subscribe for more. We're grateful to have you with us on this journey.